What's going on, everyone? Welcome to Investment for Beginners. My name is Andy and thank you for checking out this channel and our episode 5. I have made a playlist that covers basic introduction of stock, online brokerage, and investment retirement account. So check out the link in the description below so you have the basic idea of starting your investment. Just to remind you that all my videos are based on my personal experience in investing and research I gather from the websites. I am not a licensed financial advisor and I'm here to entertain you the ideal and the world of investing. As always, if you found this video helpful or insightful, consider sharing it with your friends and family. Share the world and investment together, and hopefully we can all retire with enough money to enjoy the rest of our life without having to worry about running out of money. However, keep in mind that investing is not always guaranteed money making. Alright, don't get the wrong idea. You have to do your research and you have to be patient. Most importantly, you cannot let your emotion dictate your decision. That's also a very bad thing. Stock market trading has history of crashing from time to time, from 2008 house market financial crisis, from year 2000 dot-com bubble, and its numerous of recession that happened between 2000 to all the way back to Great Depression back in 1929. Stock market crash is like a bad cold. They always come around, but they always go away, and they always get better. That's the good news. That's basically how I see stock market. They'll fall whenever recession comes around, but they always bounce back and they grow stronger and break new record. Alright, so now that my blabbering is over, let's get back to the topic of the video. In this video, we're going over mutual fund, ETF, which stands for the exchange traded fund, and bond. These are the other investments that you as an investor can purchase other than stock. I'm going to try to make this video simple as possible that high school students can understand without scratching their head. Quick disclaimer, I may miss out on smaller details of each mutual fund, ETF, and bond. In fact, I don't own any of these three in my portfolios. They're all stock, so just keep that in mind too. My plan in this video is introduce basic information to just give you a basic idea of what each of these individuals are and what are the major differences and how they work on the surface. If you want to invest in bond, mutual fund, and ETF, I would highly recommend to make sure to do further research. As with other video, make sure to do further research on whether when you check your choice of stock, online brokerage, and your investment and retirement account. Starting off, we have bond. Bond is like an IOU from a company or a government that investor, which is you, buys and holds for a certain amount of time. When that time is up, the company or the government pay back the amount of money you let them borrow. Now, while you are holding on to this IOU, you collect interest throughout each year. The longer the time you let company or government wait before they pay you back, the higher the interest they will pay you for each year. Because of the fixed amount of the interest rate of the IOU and the length of the time, bond is considered safer than the stock. You are promised X amount of money per year, and after X amount of year, you get your money back. But this is not to say bond is risk-free. The company or the government can go broke from whatever reason may be, and they can fail to pay you back because they're basically bankrupt. With that said, government IOU is safer than the one from the company because companies are more likely to go bankrupt than government. But because government IOU is safer, the interest rate is also lower. Another downside is that your interest rate may not outpace the inflation rate. Alright, on second, we have mutual fund. Think of mutual fund as a collection of bond and or stock from different diversity in all one basket, all mixed together. And when you buy a piece of that basket that hold all the bonds and stock, you owe a small portion of those bonds and stock. If you don't have time to study the company or bond, or they are deemed too confusing for you to understand what the heck is going on, it is probably better to invest in mutual fund because they have collection of different stock and bond. So your investment is not risky as if you are investing individually in stock only. If one of the stock or bond in your basket were to go bankrupt, you have other stock and bonds in the basket to make sure that your portfolio is still okay. However, there are minimum amount that you must pay for when you buy the mutual fund. The mutual fund is selected and managed by professional, but because the fund is managed by professional, you have to pay annual fee anywhere around 1 to 3% of your total value. However, there are two types of management of mutual fund, an active and a passive. As the name goes, actively managed funds are managed actively, obviously, but because they are managed actively, the annual fee will be higher than the passively managed fund. With mutual fund, you do not control what goes inside the basket, so you may not like the way the portfolio is built. But there are such options where you can narrow down up to a certain point which mutual fund is best to your taste. Lastly, when you try to buy mutual fund, the transaction will be on hold until end of the market for the day. When the market closes, that's when your transaction will be complete. Next is ETF, which stands for Exchange Traded Fund. Think of ETF as a smaller sibling to mutual fund. ETF is newly formed and smaller than mutual fund. There are similarities between ETF and mutual fund that they both collect stock and bond to create baskets for investors to choose and invest. Unlike mutual fund, the ETF can be bought and sold throughout the day when the stock market is open, along with having their own ticker symbol. Because ETF is still managed by professionals, there are annual fees, but unlike the mutual fund, ETF annual fee is usually tend to be less than 1%. Not always. ETF also has no minimum money that you have to invest like the mutual fund. So that's gonna wrap up for this video. Unlike the last video, this one came out to be a lot shorter than I expected. In the next video, I will finally review my Roth IRA account. I'll go briefly over everything about my account and my investment. I'm gonna try to explain why I choose the particular company for my portfolio, what my plan is starting next year, and anything in general. After that video, the following video will either be about compound interest to show you how your money can explode with time, or dividend where you get free money from the company periodically. So stick around and subscribe so you can check out all the videos that are yet to come. If you watch all the way to the end, I want to thank you and super smash that like button to show support. Remember, you make the money with your head, not with your feeling. Don't let your emotion get the best of you and make hasty decisions that can cost you a lot of money. But you have to also be smart to know when to cut your loss. Until next time, invest wisely.